All right, so today I wanted to talk about a stock that I have talked about before, but I want to talk about it again because recently it has had quite a significant pullback, and I think that it's actually at a fair value right now, and it appears to be in an uptrend as well. So this is Monolithic Power Systems, MPWR. First things first here, though, if you get value out of the video, please like, subscribe, comment, check out those links below. Very much appreciate the support. So getting right into it here. Market cap is a little below $32 billion. It does pay just below a 1% dividend. Free cash flow yield about 2%. Earnings yield about 5.6%. That's something I very much do like. Companies with high earnings yields that's something that's underrated to look for when it comes to investing in stocks. So it is down quite significantly from its all-time high, about 29% roughly here. But it's actually up quite nicely from its yearly low, about 14%. So it appears to be back in an uptrend, which I like. I think that's something that you also want to look for. You want to be buying stocks that are in uptrends, not in downtrends. So let's get into the, and I don't know if I mentioned there or not. It is in the semiconductor industry. They develop and design integrated power semiconductor solutions and power delivery archetypes for computing and storage, automotive, industrial, communications, and consumer applications markets. So that's basically what they do. And it looks like they're fairly diversified there as well, which is another thing that I very much do like. So let's check out the insights here. First thing, profitability numbers are extremely good. That's one of the things that attracted me to them, especially their net margin and free cash flow margin. But operating margin, gross margin, those numbers are good as well. Stock-based compensation is one of the things that definitely concerns me here, but a lot of these growthier type names, they have some higher stock-based compensation. It is concerning, but it's not the end of the world necessarily, but it definitely is concerning for me. Growth, very good numbers here. All of the numbers, they're growing very well there. And one of the best things about this company, arguably the best thing, is the balance sheet. A 6.42 current ratio, that's extremely good. They're debt-free. They've actually started buying back shares. Now, I don't know if that includes for stock-based compensation or not. I'm not actually an expert on how that works. But up until very recently, they were actually net issuers of shares, and that trend has since has changed. So that's extremely good to see as well. It doesn't mean that it's going to stay that way, but at the very least it has changed. Earnings are actually projected to be down quite a bit for the next year, but I think that's the reason why the stock sold off so much. I personally think that's already priced in. Again, I'm not an expert. I'm not an expert on this stock, but I think it is priced in personally. It is below all of its historical averages, at least for valuation. That's one of the reasons why I am going to start buying it. If we get into its financials here, revenue is at an all-time high. That number has grown quite nicely. If you look at earnings, also is at an all-time high. I don't know what caused this recent thing. Something must have been done to cause this to go from 3 to 30. Something must have been done there, and some accounting gimmick, for lack of a better way of putting it. Like I mentioned here, shares outstanding. They've been right around 49 million going back to that second quarter, actually even first quarter of 2023. They've been right around 49 million, and actually the last quarter they actually reduced the amount of shares outstanding. So they've never been a really bad issuer of shares. I mean, going back a decade, they're at about 41 million roughly. So they've never been like diluting at like 5, 6, 7, 8, 9, 10% a year, more like a 1 or a 2%. So not overly concerned there. The balance sheet, like I mentioned, is extremely good here. Assets of 2.85 billion compared to liabilities of 500 million. Like, that is very, very good. Very, very good. That's where you get that 6.4 current ratio from. So like I've said also time and time again, that in higher interest rate environments, companies that have good balance sheets are very good. They're very underrated because you got to pay more to service that debt. And especially in an economy that looks like it might be slowing, companies might have to start taking on some debt to keep up. And if you already have a lot of debt, that could be very very concerning. So that's something definitely to keep in mind. If you look at its return on equity, has actually trended down a little bit, basically since early 2023. But it's still a good number. I mean, 18%. Return on invested capital is actually better. I think that's actually, if anything, that's probably a better metric to value a company on. And that number also is actually a little bit below its historical averages, but it's still at 24%, which is very good. Free cash flow per share is at an all-time high. It's growing incredibly nicely. In fact, it's more than tripled their free cash flow over the last 5 years, which is very good to see. Revenue also at an all-time high. Revenue has also more than tripled over the last 5 years. So they're growing extremely nicely. So let's get into the valuation here just to kind of get a grip on where we should be valuing this company. So if we go back a decade, they've grown earnings 47% a year, free cash flow 31, operating cash flow 27. Average PE has been 69. They're currently at, like I said, 17. They've actually hit their decade low, was back in January. Average price to free cash flow was 429. They're currently at 72. Average price to operating cash flow, 47. They're currently at 41. So to me, it looks like valuing this company on free cash flow looks like it's the most volatile metric, so I don't think I would necessarily use that. You definitely want to be using, at least in my opinion, earnings or operating cash flow. If you look at operating cash flow, their average operating cash flow is 47. They're currently at 41. PE, they're actually well below that metric. Revenue, they've grown 22% per year. So I'm going to use earnings just because I think it's the easiest. So I'm going to project they grow earnings at just 13% over the next 10 years. They dilute 1% per year. They grow the dividend 15% per year, and they trade for a 20 PE. That implies fair value is 934, which is about 42%. I'm recording this before I release it, so it might change a little bit between now and then. But about 42% undervalued, and they're going to grow at about 14% per year. This is why I like this company, because I don't think that these numbers are necessarily overly aggressive. I mean, a 20 PE for a company that's historically grown earnings at what? 47% a year? I don't think they're going to do that in the future, but if they can do half that, which is even less than what I'm projecting them to do 13% per year. Even though they've actually stopped issuing shares recently, I'm still projecting them to dilute a little bit. Growing the dividend 15% per year. The last 10 years they've grown it at 26% per year. A 20 PE, which is pretty much a market multiple, even if we assume you traded an 18 PE, which I believe is roughly the 10-year average of the S&P, that still implies that they're 29% undervalued and you're going to grow at 12.84% per year. So I don't see any way you cut it. Maybe there's something that I'm missing. Obviously, I could be wrong. I haven't spent hours and hours and hours researching this company, pretty much just reading a couple articles and running some numbers here. I think it's undervalued. I definitely think it's undervalued, and I think that the near-term headwinds I think are already priced in, and I think that's why the stock is still trending up. If we go over to FinViz here, it is actually above the 50-day. It's still below the 200-day moving average, but keep in mind if you look at on the chart here, it was back in November that huge pullback happened. So I still think that it's undervalued. I think it's going to trend up. The one big concern would be if the broader market as a whole sells off. Typically, it's going to be the growth side of the market that sells off. So that definitely is a little bit concerning. But at the end of the day, I'm not investing for the next 6 months or a year. I'm investing for the next 10 or 20 years, 30 years. And companies like this I think are going to do well. So that is my thought process. Like I mentioned at the start of the video, if you got value, please like, subscribe, comment, check out those links below, and stay tuned for more.